Hey, Sue payday hits, and your balance looks smaller. Today we decode gross versus net pay, the taxes and deductions, how to estimate your take-home, and how to budget with the number that actually lands in your account. You work hard for your money, you put in the hours, you do the work, and then that glorious payday arrives. But wait, why is the number in your bank account so much smaller than the number you expected? Welcome to the factual, sometimes depressing world of taxation, and the difference between gross pay and net pay. The concept is simple. Gross pay is the total amount of money you have earned, before any deductions. This is the big, exciting number your employer tells you about. Net pay, on the other hand, is the amount of money you actually get to keep and spend. It is your take-home pay, the number that hits your bank account. The difference between these two is where financial confusion and sometimes genuine shock occurs. It's the gap where the government and other agencies claim their piece, sometimes turning a tidy sum into a much less tidy one. How does this work? That difference is made up of mandatory deductions. The main ones, which are universal and factual, are taxes. In most countries, you will see deductions for national or federal income tax and specific payroll taxes. For example, in the US, this includes FICA taxes, which fund Social Security and Medicare, programs you will eventually use. These taxes are calculated based on your earnings and your W-4 form. Then you have state and local taxes, which vary factually based on where you live. Think of gross pay as the full pizza, and the taxes as the slices automatically claimed by the financial system before you even open the box. No, you can't politely decline the tax slice. It is a mandatory contribution. Let's use a factual simplified example. Imagine your gross pay for the month is $1,000. After mandatory deductions, let's assume 15% for federal, 5% for state, and 7.65% for payroll taxes. That's a factual total of 27.65% deducted. You don't get to spend $1,000. Instead, $276.50 is deducted and sent to the appropriate government agencies. Your net pay, the money you can actually use, is only $723.50. Understanding this reality is crucial, especially when setting budgets or figuring out if you can afford that new thing you want. You must budget based on your net pay, never your gross pay. The danger of ignoring this is factual and immediate: overspending. If you plan your budget based on the big, flattering gross pay number, you will factually be short on cash every single time your net pay lands. The benefit is clarity. By understanding your deductions, you can correctly calculate your actual budget and make smart financial decisions. It also demystifies the system. The money isn't just vanishing, it's paying for the services that keep society running, from roads to schools. The single most actionable takeaway for you today is this: when negotiating pay or setting a budget, always focus on your expected net pay. Find a reliable online calculator to estimate your take-home pay based on your hourly rate and estimated hours. Plan your life around the money that actually lands in your account. Finally, remember, this is not financial advice, only education. The principles discussed here are factual and based on standard payroll deductions, but tax laws vary widely. You must do your own research. Consult the official guidelines for your region and speak with a professional tax preparer before making any complex financial decisions. Now, go find that pay stub, check the numbers, and stop letting your gross pay lie to you.